Continuation from the previous lesson, we will look deeper into assessment of risk. What is assessment of risk? It is the act of auditor in deciding his view on financial statements. An auditor will have to follow few steps to ensure the true and fair view of the financial statements in every aspects. Nonetheless, there are some risks that the auditor may not be able to detect directly. These usually happen due to the use of testing. The use of testing is when audit cost incurred is high and may not justify the benefits derived. Test of control and substantive tests are performed on material items selected through sampling techniques. Next is the inherent limitations of any accounting and internal control system. ICS is designed by management. However, errors will still occur due to negligence, inefficiency, wrong judgment and communication breakdown. Last but not least, most audit evidence is persuasive rather than conclusion. The data that substantive the financial statements are historical in nature and time and manpower constraint. Risk itself is a basic notion in audit process. Risk in auditing means that auditor is willing to accept the uncertainty in performing audit function. As such, the auditor identifies the unreliability of evidence, effectiveness of internal control and if the financial statements are free from material misstatements. Two types of risks are known as audit risk and auditor's business risk. Audit risk explains on the situation where an auditor does not have all the information of his client's business, hence the possibility of misstatements of financial statements. To make sure that he has all the information, he needs to plan his work with due care and exercise it with inquisitive mind. This type of risk can be controlled directly. The auditor may reduce the risk to an acceptable level by observing and conducting audit practices in accordance with approved accounting standards and the firm's quality control. Auditor's business risk is a risk that cannot be controlled directly since it happened because of auditor's exposure to his professional practice from litigation, adverse publicity or other situations that arises in relation with financial statement audited and reported. Inherent risk is defined as a possibility of error or misleading information in accounting statements due to other factors other than control risk. There are two levels of inherent risk, namely financial statement level or entity level, and account balance and transaction level. There are things to consider during assessment for the financial statement level. First, we need to consider the nature of client's business, size and number of location of the company. Next is the management, which includes experience, integrity and attitude of directors, and lastly, unusual pressure of management. It is important to note that the industry may be affected by the entity's position within the industry, threats to the entity or operation that occurs in a highly competitive environment. As for account balance and transaction level, it is a result of previous audit whereby misstatement found in previous audit have a high possibility to occur again in current year due to slow changes some company adopt. Therefore, respective transactions or balance of accounts should be rated with higher inherent risk. Next, non-routine transaction is a transaction that rarely occur, may be wrongly recorded due to inexperience in the transaction.
Next, we will discuss on control risk. What is control risk? Control risk is the risk of a material misstatement in the financial statements arising due to absence or failure in the operation of relevant controls of the entity. So, basically, it is an auditor's assessment on effectiveness of internal control to prevent or detect material misstatements. There are two levels of control risk, which are general level and specific level. In general level, auditor should inspect the attitude of management towards the control system, whether the company has an established budgetary system, internal audit department, risk management department and audit committee. Meanwhile, in specific level, auditors should evaluate whether existing control procedures is good enough to prevent or detect errors or not. Next, we will discuss on control risk. What is control risk? Control risk is the risk of a material misstatement in the financial statements arising due to absence or failure in the operation of relevant. There are 4 audit procedures used to minimize detection risk, which are classification testing, completeness testing, valuation testing, and occurrence testing. There are 2 levels of control risk, which are general level and specific level. In general level, auditor should inspect the attitude of management towards the control system, whether the company has an established budgetary system, internal audit department, risk management. Meanwhile, in specific level, Auditors should evaluate whether existing control procedures is good. And lastly, occurrence testing is used to determine whether recorded transaction had taken place.
Sampling. What is audit sampling? It is a process of choosing a subset of a population of items in making inferences of whole population and obtaining and evaluating the evidence, characteristic of the item selected, in order to assist in forming a conclusion for the population. Representative sample. It is a random drawn from population. A large sample allowed the auditor to make valid conclusion or inference about the whole population. It can be evaluated in terms of precision and reliability.
Reasonable assurance is a level of confidence that the financial statement is fairly and carefully recorded in all material respects that an auditor is supposed to attain from an audit.